Hey, what's up, guys? So recently the Fed announced that they were going to do a half-point rate hike in order to start reeling inflation in. That's going to be the largest rate hike that we've had in the last 20 years. So in today's episode, we're going to be talking about how that rate increase is going to affect just people as a general consumer, how it's going to affect people that are investors like myself, how it's going to affect the real estate market in general. So let's just go ahead and dive right in. In my personal opinion, I think that this was long overdue by the Fed. I think that a lot of economists were saying towards the tail end of last year, when we were starting to see signs of it more prevalently, that they should have taken action back then. So it's certainly better late than never. But in my opinion, I think that they're behind the curve. I think it's great, but I also think that they need to accelerate that. So more increases and much, much faster than the pace that they're currently operating at. So the con in a lot of people's eyes is that if they do increase the interest rates, which they are clearly doing at this point, that in order to stifle inflation, or while stifling inflation, they're going to ultimately crush the economy, and the fear is going to be sending us back into a recession. Now, what does this news matter to me? I mean, plain and simply, it means that if I intend to borrow money, it's going to be more expensive money than it would have been with lower interest rates. So I personally don't have a lot of high debt, particularly credit card debt, but if I did have a lot of debt, particularly high interest debt, I would be doing everything I could right now to either pay those off or ultimately consolidate that debt with a lower interest rate, while at the same time trying to boost my savings. If you do have a variable rate credit card, which most are, you can expect that your interest rate is going to start going up over the next billing cycle. So be aware of that, be cognizant of that, use those cards appropriately due to that. You can also call in and talk to the credit card companies and get your interest rate lowered, or try your best to keep it lowered. As we talk about here often on the channel, there's nothing wrong with being prepared. If you're looking at it from a homeowner standpoint, rising interest rates are not really going to affect you. Most 15 and 30-year mortgages are going to be tied to treasury yields and the broader economy as a whole. But the average rate did just hit 5.55%, which is up over 3.11% just since December alone, which is the highest since 2009 we're at right now. If you're taking a look at this from an auto loan or a student loan standpoint, those are going to be fixed rates as well, so that's not going to have any impact on you. If I'm taking a look at this from an investor standpoint, which I've been a full-time real estate investor for a number of years here at this point, so this is a lens that I'm always going to look at these things through. Things like inflation are certainly on my radar right now. Things like Ukraine, which are certainly going to be an unknown, those are things I can't necessarily control, but I'm going to keep my eyes on them and I'm going to react accordingly. But one promising thing from an investor standpoint that the Fed did say is when Jerome Powell said that, he went on record and said there may be up to 6 more of these rate hikes just this year alone. And obviously inflation is going to drop. The rates are going to continue to rise, which as an investor, I do like that. Ultimately, what that's going to do is bring down some of the prices of the home. Inventory has obviously been through the roof. Everyone's seen that over the last couple of years. So it's going to bring prices, make them more affordable for me as an investor. And it's also going to eliminate some of my competition, particularly investors that, rely on getting funding, whether it's traditional, conventional, private, hard money, all of those are going to be a little bit tougher to jump through. So those restrictions, particularly on investors that need that financing, are really going to help my cause. So as an investor, rising interest rates are ultimately going to help me by reducing the cost of the inventory that I'm out there looking at. So therefore, depending on the deal, sometimes high interest rates can actually be the best time to buy for an investor. So my advice to other investors out there is always just going to be keep your eyes and your ears open. Over the next year, there's going to be a lot of opportunities. Obviously, rising or shrinking inflation and rising or lowering interest rates are going to have a bearing on a deal. So certainly take it on a case-by-case basis, because these changes are certainly going to be, affecting you positively or negatively on each and every deal. And again, it's also going to depend on if you are a investor that needs funding or financing, or if you're going to be a cash buyer. So if you are in need of financing on your projects, you may take a look at, doing a lot of buys right now before the interest rates continue to go up. When you're buying for cash, for example, inflation is going to be your friend by lowering prices, but it's also going to depend on what your exit strategy is going to be. So you have to take that into consideration, guys. If you're going to be you're buying as a long-term buy and hold investor, that's going to be fine, because it's not a property that you're going to be turning around and trying to sell, on the retail market anytime soon. So if you're a buy and hold investor, you don't really need to be, kind of leery of any of the rising rates right now. Obviously, you want to buy them before the rates go up, but the exit strategy is going to be perfect, because you're not turning around and trying trying to sell them retail right now. I would tell flippers though, be a little bit cautious right now, because that exit strategy is going to require you doing the work on the house, obviously, to get it, move-in ready. And then you're going to have to be selling that in most cases to a retail buyer, which is in most circumstances fine, especially with the hot market that we've just had. But as that market starts to cool down, banking restrictions are going to get a little bit tighter. There's going to be a smaller pool of buyers that are going to be viewing the home and are going to have that buying capability or the buying power on that. So you might have bought the house perfectly up front, or so you thought, with the market conditions as they stood. But as market conditions change, that price may end up having to drop. You've got a smaller pool of buyers. Supply and demand obviously is going to, play into the equation there. So, you may have what you thought was going to be a higher ARV, so your after repair value you thought was going to be X, but ultimately with the market corrections, it may be Y, which is obviously just going to lower your spread. And you just want to make sure that you're not in a position where there's not enough meat on the bone, and that correction could ultimately put you upside down or underwater. The last thing you want to do on a flip, of course, is lose money. And in that same vein, another, kind of tip for investors that are out there right now is, because of market restriction or banking restrictions going to be getting a little bit tighter, and that pool of buyers might be shrinking a little bit, you might take a look at getting your cost basis down a little bit more on your purchases. So the lower the price point of the home, if you take a look at kind of the buying pyramid, there's going to be a bigger pool of buyers down here at say 200,000, then 300,000, 400,000, 500. You get the gist of it. All the way up, there's that pyramid. It's going to be more expensive homes, but the pool of buyers is going to be shrunken down. So at that lower price point, you're certainly going to have a larger pool of buyers than you would say in that $1 million space. Obviously, that's going to be market dependent. A $300,000 house in Jacksonville, Florida, might be $1 million house, or vice versa somewhere else. So obviously take a look at market conditions, but that's certainly something to be cognizant of. If you kind of want to play the market, you may consider dropping that price point down just a little bit in order to attract more buyers, or at least have the opportunity to kind of fish in a bigger pond. As always, all of these variables need to be considered and researched, but if I'm giving advice to investors out there, obviously it's going to be dependent on the deal itself. It's going to be dependent on their personal financial situation, whether they're getting lending or they're cash buying. But I would certainly give a green light for investors right now. So as we always say here on the channel, and I'm going to repeat that again, always stay ahead of the curve. So, you want to find the trends, you want to be out in front of those trends. If everyone else knows about the opportunity, the likelihood of the opportunity being as good or as lucrative as it could be had you gotten in much earlier, obviously going to be diminished. So we always say, try and get first to the trough. So in my opinion, I think years and years of underbuilding, and I think at this point, millions and millions of millennials that are at that, point in their life where they're starting to get into the home buying market, I think that has created a serious imbalance in supply and demand, and that's why we're seeing a lot of what we're seeing. I think that also is going to keep the real estate market propped up. The raising rates may slow demand down a little bit, but I don't see appreciation stopping, just slowing down a little bit as well. As always, guys, do your own research, and we'll see you on the next video.